So you think that obviously some of these estimates were brought down. Earnings season is on its way. Today is the busiest day so far. How are you feeling?
Well, I'm actually feeling kind of upbeat because, of course, we went into this earnings season, as you point out, with very low expectations, with close to down 5% overall. But by and large, we're beating. About 81% of the S&P companies that have reported so far have beaten. Traditionally, that's only around 65%. Only 13% have disappointed, and traditionally it's around 20%. So on balance, I like what I'm seeing.
Right. So that's why you actually say to buy some of the cyclicals on the dips. What kind of sectors in particular are you watching and you think maybe there's a good buy there?
Well, certainly we're looking at the industrials. I mean, you know, the industrials are a type of thing where they've now pulled back so far. I think they're going to get a tailwind from a couple things. Number one has to be the Federal Reserve. We're going to see the third cut in as many months next week, I believe, from the Federal Reserve. And I think given some of the weakness in the manufacturing sector, given some of the weakness we heard about in Germany and the parting comments from Mario Draghi, I think they're going to be prepared to give even more rate cuts. Plus, of course, they have to uninvert that yield curve. They've got to get the short-term rates lower so that they're a little bit more in sync with what's going on in Europe.
I think some of the other things you said that you might be interested in, that you're watching at least, energy, financials, maybe some tech. You like those?
Yeah, absolutely. Let's look at the energy. Now, energy has a reputation among investors now even worse than tobacco. But there's one area of energy I think offers some opportunity, which is the so-called clean energy. It's not as clean as we'd like, but that's natural gas. And now we've just seen recently next era energy company down in Florida, DTE, a mid-market utility, buy into the pipelines. Why are they doing that? Because they know they need that natural gas to keep the generation of electricity up, which we all need. If you're not sure whether you need the electricity, see what's going on in California. So anyway, so a company I'm noting is EOG Resources. Why do I like it? Very low debt. It's down about 50 points over the last 14 months. It has some of the highest quality plays in the Permian, in the Bakken, which we absolutely need in order for us to have the electricity production going forward.
So a name like EOG, which you rightfully point out, it's been beaten down. And you like it because of some of these fundamentals. At what point do you say, oh, gee, you know what? It took another leg down. I don't think I want to own it.
Well, yeah, I mean, I think you want to look at what the peers are doing. Is all of a sudden someone's proclaimed the death of natural gas, that somehow we'll just use renewables going forward? If that's the reason, that's one thing. If it's a company-specific problem, you really got to roll up your sleeves and figure out what did they do wrong? What's the balance sheet look like? What does management have to say?
How about Carnival Cruise Lines? I mean, I love these kinds of airlines and cruise lines and, travel and leisure. It's a fun group to watch, but it can be a little volatile sometimes based on the consumer or anything, global stories or foreign exchange rates. I mean, you like Carnival.
So for the key for me with Carnival is that 60% market share. We don't have a leisure company out there, certainly not among the airlines, that has that 60% dominance. So we know that 5, 10, 15 years from now, baby boomers, such as myself, are going to want to do more cruising, and so you want to bet with the big guy. Now, they've been buffeted recently, a little turbulence, to use the sea analogy, because of the higher dollar, because of some of the concerns over what's going on in Asia, because that's an important part of their customers, and also, of course, recessionary concerns. But at the end of the day, that only helps the big guy. Meanwhile, while you're waiting, Nicole, you get that 4.5% dividend, about 3 times what you get in a 10-year treasury.
Yeah, and that's a good one, right? You make a good point about the dividend. Another name that you like is in healthcare, right? CVS.
So CVS, it's got 3 different ways to make money. They've got one of the largest drugstore chains across the country, 10,000 stores. They're also big in the pharmacy benefits, the largest pharmacy benefits player out there, which helps companies save money on drugs. And now, of course, they've recently finished their acquisition of Aetna. So they've got one of the largest health benefits players, the 3 of them together. Meanwhile, again, you've got a 3.1% dividend, which historically has grown about 12% per year. You're a good 25% off of its recent highs.
Yeah.
So I think this is a company to bet on.
Yeah, what's interesting is it's multiple revenue streams, right? I mean, you seem to always pick names that are leaders or that have been beaten down but have a great fundamental story, and they have the dominant market share. I mean, they're the dominant players.
I think that's so right. So, sometimes companies go away, but industries don't usually go away. So when an industry is down and out, look for the biggest player that can survive and actually profit from the little guys falling off the table.
Yeah, I know you also like Annaly Mortgage and Invesco. Which one do you want to touch on?
Let's talk about Invesco. So Invesco recently bought Oppenheimer. So now it's got 1.2 trillion assets under management. Now, active management is way out of fashion, of course. Having said that, of course, you're buying a company that's trading about 5 times earnings, which has over a 7% dividend yield, very low debt, and actually they've experienced higher margins and better success among all the active managers out there. 30% of their business overseas, so they're well diversified.